Welcome to The Explainer. Today, we're doing a deep dive into Fortrea's Q2 2026 earnings report. And honestly, beneath all the dense financial jargon, there is a truly fascinating turnaround tale here. Now, if you've been following the contract research organization space, or CROs as we call them, you already know it's an industry that's incredibly sensitive to macroeconomic headwinds and biotech funding shifts. But today, we're looking at a company that is actively rewriting its own narrative. We're going to unpack exactly how Fortrea is shifting from the heavy financial burdens they faced back in 2025 into what looks like a stabilized, margin-expanding machine today.
Here's our roadmap for today. We'll briefly cover the strategic transformation, unpack those Q2 financials, check on their liquidity and cash flow, look at how they're building out their backlog, and finally, review their upgraded 2026 guidance. Let's get right into it.
Section 1. The Strategic Transformation. Okay, before we completely drown in spreadsheets, let's just ground ourselves for a second in the big picture. What does this company actually do? Well, as a leading global contract research organization, Fortrea partners with biopharma and medical device companies. Basically, their core mission is to drive the healthcare innovation that accelerates life-changing therapies to the patients who need them. We're talking phase 1 through 4 clinical trial management, clinical pharmacology, consulting, the whole shebang. And understanding this is absolutely crucial because their financial health is directly tied to how efficiently they can execute these massive, complex clinical trials all over the world. It's like a giant logistical puzzle.
Now, listen to what CEO Anshul Thakral is emphasizing here. 4 consecutive quarters of execution. He is definitely laying down a marker with that phrasing. This isn't being framed as some one-off, lucky quarter, right? It's being presented as a deliberate, sustained operational rhythm. And that rhythm is the momentum underpinning this entire report. When a management team goes out of their way to highlight a 4-quarter streak, they're essentially telling the market, hey, our internal restructuring and strategic realignments, they are firmly taking hold.
Moving right along to Section 2, unpacking Q2 financials. Let's play detective for a minute and see how that strategic execution actually translates to the balance sheet. The first thing that jumps out is the stark contrast in net loss. I mean, we're looking at a massive 96.5% improvement year over year. Back in Q2 2025, Fortrea reported a staggering net loss of $374.9 million. But context is everything here. That 2025 result was heavily dragged down by a non-cash goodwill impairment charge of about $309 million. Fast forward to Q2 2026, and that net loss has shrunk to just $13.2 million. You'll also notice their adjusted EBITDA is actually up to $58.7 million, even though top-line total revenue dips slightly from $710 million down to $678 million. Now, you might be scratching your head about that slight revenue dip we just talked about. Well, that basically comes down to what the industry calls pass-through costs and how they heavily impact top-line revenue over time. In the CRO world, these are expenses like investigator fees or patient travel that the CRO pays on behalf of the sponsor and then gets reimbursed for later. They don't typically generate any profit margin. Historically, pass-through costs fluctuate anywhere from 31 to 40% of total revenue, quarter to quarter. So when these costs naturally ebb and flow based on where active clinical trials are in their life cycle, top-line revenue just moves right along with them, completely independent of the company's core operational profitability. So here's the absolute crucial takeaway from all that. Despite a lower total revenue number, underlying profitability actually grew. Fortrea expanded its adjusted EBITDA margin by 93 basis points, bringing it up to 8.7%. This tells us loud and clear that their internal efficiency measures are working. The company noted they're well on track to deliver their fiscal year 2026 cost optimization targets of $70 to $80 million in gross savings. They are quite literally doing more with less, which is exactly what you want to see in a turnaround scenario.
All right, Section 3, liquidity and cash flow.
You know, a comeback story is great on paper, but a company needs actual cash in the bank to fuel operations and manage its debt. Looking at their liquidity profile, Fortrea is carrying a gross debt of just over $1 billion, with $168.6 million in cash and equivalents. That leaves a net debt of $897.7 million, which translates to a net leverage ratio of 4.3 times. But the real standout metric here is the positive free cash flow of $19.9 million for the quarter. Compare that to their year-to-date negative free cash flow of $5.1 million, and you can clearly see that Q2 was a pivotal moment for generating positive cash from operations. It gives them some incredibly vital breathing room. Next up, Section 4, building the backlog. Okay, let's pivot. We've looked backwards at cash, now let's look forwards at future business. To do that, we need to understand the book-to-bill ratio. In this industry, it is a vital metric. It's simply the ratio of net new business awards to the revenue recognized in that exact same period. So if a company recognizes $100 million in revenue, but books $120 million in new contracts, the ratio is 1.2. Basically, anything above a 1.0 indicates that the pipeline is growing faster than the company is earning through its current work. And for Q2, Fortrea delivered a very solid 1.06 times book-to-bill ratio. Actually, if you zoom out to their trailing 12-month book-to-bill, it sits at an even stronger 1.12 times. This marks their fourth consecutive quarter staying above that critical 1.0 growth threshold, which perfectly reinforces the CEO's earlier comment about consecutive quarters of execution.
And what happens when you keep winning business at a steady pace? Your total backlog balloons. Right now, it's sitting at a staggering $7.8 billion. That represents a 3.3% increase compared to Q2 of 2025. In the highly volatile world of clinical trials, a massive growing backlog like that is basically the ultimate shock absorber. You can really see the steady upward march playing out quarter after quarter. The company specifically pointed out that first-half net new business awards were up 19% year over year, and they're seeing continued growth pushing into the biotech sector. Meanwhile, their burn rate, which is just the speed at which they actually convert that massive backlog into revenue, remains relatively stable, hovering in the mid-8 to low 9% range.
Which brings us to our final part, Section 5, Upgrading 2026 Guidance.
So you've got an expanding backlog, stabilizing margins, and cash is flowing positively again. What does management do with all that? They officially increased their full-year guidance. And let me tell you, when management raises guidance, it's one of the clearest signals you can send to the market that internal visibility has improved and operational confidence is sky high.
Looking at the updated numbers, notice how they bumped up the revenue floor from $2.55 billion up to $2.62 billion. But the really interesting part is the adjusted EBITDA. They significantly tightened and lifted the bottom end of their profitability expectations, moving it from $190 million up to $205 million. This proves that the margin expansion we discussed earlier isn't just some fluke. It's fully baked into their forecast for the rest of the year.
And taking a look at that new high-end revenue guidance of nearly $2.7 billion, that is a massive number. It basically screams management's absolute confidence in this turnaround and their ability to successfully execute on that massive $7.8 billion backlog.
So what's the big takeaway you should have from this explainer? To put it simply, Fortrea has successfully pivoted from those heavy, impairment-laden losses of 2025 into a stabilized machine. They're controlling their costs, they're expanding their adjusted EBITDA margins, they are generating positive free cash flow, and they're stacking up new contract wins at a rate that consistently outpaces their revenue burn. I want to leave you with a provocative thought to chew on. If they manage to achieve all of this in essentially just a 4-quarter turnaround, is this highly efficient state of execution simply the new, stable baseline for the company? Or are we witnessing the very beginning of Fortrea's next major growth phase as biotech funding potentially starts to normalize? Keep a very close eye on those book-to-bill ratios and margin percentages over the next few quarters to find out.